We have a great phrase today on the Bloomberg talking about a year of fire and ice, that
Yes.
the decade began really with everything crumbling and a lot of panic. And now we're sort of heading into a new year when apparently nothing can go wrong.
I think part of the reason why markets are acting like nothing can go wrong is because people believe that everything is going to go wrong. Now, that has created what we call the silent MeltUp. And so the way we explain that is, and this is actually related to the fire and ice title, which I think is excellent, is because there has been a complete change in the relationship between bonds and equities. Now bonds, or longer duration assets, are used as a hedge against long equity exposure globally. And that's used as a deflation hedge. Deflation was not something that existed pre the global financial crisis. It does seem to exist now, and there's only really three asset classes you can hedge against deflation, which is JGBs, bonds, and US Treasuries. So that is anchored 10-year rates. That is why your term premium is negative 90 basis points according to the New York Fed. So as a result, stocks still look really attractive. As long as cash returns are high, which they are, 80% of S&P companies have total cash yields, including dividends plus buybacks, above US Treasury yields. We've never seen anything like that.
When you talk about deflation, just give us some more details on where you're seeing it and what you mean by deflation.
Well, so I say deflation hedging. Hedging. We don't actually see deflation. We see very low inflation, which everybody in the Western world has covered. What we do see is, since the global financial crisis, this desire to hedge against the potential for deflation, because that is not something that existed prior to the global financial crisis. It was believed that monetary policy could always and everywhere cause inflation by just increasing the money supply enough. When that turned out not to be totally true, when it turned out that monetary policy was a relatively weak tool, that changed the dynamics in the financial markets. It created a lot of uncertainty. It created fire and ice, quite frankly. Associated with that was a lot of political uncertainty and a whole bunch of things that have been covered. But what it has done is really change the dynamics in asset classes, where bonds are telling you something different than they did historically, right? They are now a deflation hedge. Right? That is where you go to offset your equity risk, which anchors them. And as long as your cash returns are high and you're using that, so your risk-free rate is below your trend GDP growth rate and earnings are growing, stocks are really attractive.
I just want to dig in a little bit more into this idea of deflation hedging. Do you see deflation at some point down the line? I mean, we're not seeing it in any of the expectations, readings that we're seeing from the consumer.
Great question, and thank you for pressing me on that. You don't see it, but it seems fairly high odds that in the next recession, which I think most would argue is fairly likely in the next 10 years, that you wouldn't necessarily have deflation, but you would have significantly weaker economic growth, inflation that is going to trend lower, potentially even go negative for a little bit, at a time where monetary policy will not be as effective as offsetting it. So, because that would be such a negative scenario, like deeply negative scenario for economy and earnings, et cetera, you hedge that risk with long duration assets like treasuries. So it's just the probability set of saying, over the next 10 years, is there likely to be a recession? Some would say, yes. How do I offset that if in deflation to actually come with that?
So you're saying this move that we saw in treasuries and what we're seeing now, which is a range of 180 to 190, say, on the 10-year, that this is thanks to active participants much more so than the Federal Reserve, for example?
Absolutely. I think I don't want to give you a sense of false precision on this, but I would say the majority of it has to do with some sort of deflation hedging, lack of safe assets globally.
And this then is why your outlook 2020 is how I learned to stop worrying and love the market, because you don't see dynamics changing anytime soon.
No, I think no, it doesn't appear that they will. We've been fading the idea that recession risk was high. So as long as consumers are strong, labor markets are strong, and unemployment rates are dropping globally, it's very hard for us to see a recession. I wouldn't extrapolate weakness in the ISM, to use a pre-Amazon era term. If consumers are coming into your store and buying things, companies are going to put stuff on the shelves. They're going to produce. So it's highly unlikely to see a recession in our view outside of a shock. And then the other dynamic that would change it is significantly higher inflation. And, I would bet on, if I was to bet on something that would kind of change our view of the market, I think we'd hedge more towards higher inflation than we would disinflation or deflation recession. And the reason that is very important for investors to grasp is there doesn't seem to be a political constituency out there in favor of lower deficits. And there seems to be a significant amount of governments in the developed world, in particular, with the desire to increase fiscal spending at a time when unemployment rates are very low globally. So as we test this idea that the Phillips curve is broken, as we test these ideas that inflation is low forever and we can push the unemployment rate lower, continuing down towards zero or whatever, maybe we will see a little higher inflation. I'm not saying that's not a base case. I'm just saying that's where I think the more interesting risk is there to think about.